Welcome to Success Series. Today we are going to talk about IFRS 13, Fair Value Measurement. Now, the concept or the standard IFRS 13 is very essential as it's going to help us to know how to apply or how to get the numerical value to use for our element of our financial statement. And one of the methods for ascertaining the value of it is fair value. So today this standard is going to enlighten us on the measurement of fair value. Let's dive into today's discussion. Now we have to look at the objective of the standard IFRS 13 first. Now let's look at the objective. You see the objectives are to define fair value. So here we'll look at the definition of fair value. Then to set out in a single IFRS a framework for measuring fair value. So here we are going to look at a pathway on how to measure fair value. And then the last one, to require disclosures about the IFRS measurement. Now let's start with the definition. Now fair value, what is fair value? So according to IFRS 13, fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. Now take note, you can only say that the exit price over here is the price that will be required to sell an asset or pay to transfer a liability. We call this price the exit price. Now here we are saying the market participant here should be based on market-based activities. So it should be based on market-based activities mainly. Now since you are based on market-based activity, there are certain key things you have to look at. So when an entity performs fair value, it must determine the following. So an entity must determine the following. Now first thing is that a particular asset or liability that is the subject of the measurement. So a particular asset or liability that is the subject of measurement. And here we are saying that that particular subject of measurement should be consistent to that particular asset unit of account. Now for a non-financial asset, the valuation premise that is appropriate for the measurement. So here for a non-financial asset, we are trying to say that you are going to be based on the use of that non-financial. What is it used for? So you are going to be based on the use. And in based on the use, you have to look at the highest and the best use of that non-financial asset. And then we have the principal or advantageous market for the assets or liabilities. And then lastly, we have the valuation techniques appropriate for the measurement. And here that's what we are going to look at, or based on the availability of the data with which to develop the input, and then the level of the fair value hierarchy. So we are going to touch on bits of all these in today's tutorial. Now let's look at the particular asset or liability, which is the main subject of concern. So over here, we are saying that the asset or liability measured at fair value might either be a standalone asset or liability, or a group of assets, a group of liability, or a group of assets and liability. So here we are just trying to say that when it's a standalone asset or liability, then it means that that particular one is singled out, or it could be in the form of a portfolio of the several assets and then its liabilities as well. Now with all this, you have to bear in mind that we use its unit of account to help us in that regard. So there's a key thing we have to note is that whether assets or liability is a standalone or a group depends on its unit of account. Now let's go to the applicability to the non-financial assets. Here is where we say that we look at each use, and each use must be the highest and best use. So let's look at that. The fair value of a non-financial asset shall be measured based on its highest and best use from a market participant's perspective. And we look at that the highest and best use takes into account the use of the asset. That is, we have some conditions which must meet for the highest and best use. The first one is that it must be physically possible. Physically, it should be possible. Now second, it must be legally permissible, backed by law. And the third one, it must be financially feasible. So these are the three conditions for the highest and best use. Now let's go to the valuation approach. Now the valuation approach helps us to know the valuation techniques we are expected to apply in order to measure a particular instrument. Now we have three major approaches. We have the income approach, the cost approach, and then the market approach. Now let's look at each one of them. The market approach. So here we say the market approach uses prices and other relevant information by market transaction. So here we use information about the particular transaction. And examples of such techniques are the matrix prices and then the market multiples. The second one is the income approach. And then with the income approach here, it converts future amount to a single current amount. So it converts future amount to a single current amount. And here we look at the following examples. The following examples that we use the present value, the lightest method, the relief from royalty method, and the others. Then we have the third one, which is the cost approach. And with the cost approach, it reflects the amount that will be required currently to replace the service capacity of an asset. So here we look at the amount that will be required currently to replace the service capacity of the asset. And here we say that a method, a technique over here is a depreciated replacement cost method. So the depreciated replacement cost method is an example of the cost approach. Now let's come to the fair value hierarchy. Now based on this, we have a fair value hierarchy which will help us to know which ones that we should consider in terms of priority. Now let's check, or let's dive into that. Here they are categorized as follows. We have the first one, which is the level 1 input. What are level 1 inputs? Now here we say level 1 inputs are quoted prices in an active market for identical assets or liabilities that the entity can access at the measurement date. So here one key thing you have to take notice that it's for what? Identical asset or liability. And here an example of level 1 is basically our shares which are traded on the stock exchange market. This is a typical example of the level 1 input. Now let's dive to level 2. Now with level 2 input, what are they? They say they are inputs other than quoted prices included with what? Level 1. What this means is that they are inputs and does not include level 1 inputs. That's one thing you must take note first. So they are inputs other than quoted price, market price included with level 1 that are observable for the asset or liability either directly or indirectly. So here they are observable for the asset or liability either directly or indirectly. So level 2 we basically look at observable inputs over here. Level 2 deals with observable inputs. And here what are some of the examples with line with level 2 input? We say level 2 inputs include quoted prices for similar assets or liabilities in active market. So here we look at quoted price for similar. So here's what we consider similar. Here is no longer identical but what? Similar assets or liability in an active market. The second one we consider is quoted price for identical or similar assets or liabilities in market that are not active. So here they may be identical, alright, but the market in which they are found in must be what? Must not be active. And in that way you can use the level 2 input. Then inputs other than quoted price that are observable for assets or liability. So look at the observable inputs that are for asset or liability. Then we have to level 3 inputs. So we say level 3 inputs are they are the unobservable inputs. So level 3 are basically unobservable inputs for that particular asset or liability. Examples that we have is the financial forecast, historical volatility, and then many others. And then we have a key thing now you have to know that with an entity to develop an unobservable input using the best information available in circumstance, which might include the entity's own data, taking into account all information available on market participants' assumption that is reasonable what available. So here it's basically talking about in determining information for unobservable inputs, we have to consider the entity's information, considering information of the market participants in order to generate those measurements for the level 3 input. Thank you.